The UK debt-to-GDP ratio just crossed 100% for the first time since the early 1960s. That number appeared in the Office for National Statistics release 3 weeks ago. Most coverage focused on the headline. Almost no one noticed what happened in the gilt market the same week. Let me explain what that actually means before we go further. Debt to GDP is simply the total amount the government owes divided by the size of the entire economy in 1 year. 30-year gilt yields touched 5.225% on January 23rd. Now, a gilt is just the British name for a government bond. It's how the government borrows money. When you hear 30-year gilt, that means the government is borrowing money and promising to pay it back in 30 years. And the yield is the interest rate they're paying. The move was small, 40 basis points in a session. A basis point is 1/100th of a percent, so 40 basis points is 0.4%. That doesn't sound like much. But the speed mattered more than the size, and if you understand what sits beneath that curve, you know why that matters. I'm going to show you why this crossing isn't a symbolic threshold. It's a structural one. And I'm going to walk you through the mechanics of what happens when a government that's already borrowing $151 billion a year starts competing for the same collateral that pension funds need to stay solvent. By the end, you'll understand why this isn't about debt sustainability. It's about liquidity sustainability, and why the system is already starting to reprice that risk. I monitor UK gilt flows, pension fund positioning, and sovereign debt mechanics because these markets don't wait for headlines. They reprice quietly in basis points and spread widening long before the fiscal data catches up. And what I'm seeing now is the same signature we saw in September 2022, except this time the buffers are thinner and the trajectory is worse. Think of financial markets like a poker game where the cards are dealt face up, but most people are only watching one or two players. I'm watching the whole table. Gilt flows means tracking who's buying and selling government bonds and how much. Pension fund positioning means understanding how these massive retirement funds are invested and what they'll be forced to do when markets move. Sovereign debt mechanics is the technical term for understanding how governments actually borrow money and what happens when that system gets stressed. These things move in predictable patterns, and right now, the pattern looks like stress building in the system. Let me explain one term before we go further. When we talk about debt to GDP crossing 100%, we're talking about a ratio. Think of it this way. Imagine the UK economy is a person earning $50,000 a year. That's their salary, their total income. Now imagine that person has $50,000 in debt spread across credit cards, car loans, and a mortgage. Their debt-to-income ratio is 100%. They owe exactly 1 year's worth of income. Now here's the critical part. That's manageable. If the interest rate on all that debt is 2%, you're paying $1,000 a year in interest, which is just 2% of your $50,000 income. You can handle that. But it's a completely different problem when interest rates are 4.5% and your income is not growing. Now you're paying $2,250 a year just in interest. And if your salary stays flat while your interest payments more than double, you're in trouble. You either need to cut your spending dramatically, find a way to earn more, or take on even more debt just to pay the interest on your existing debt. That's the trap the UK government is in right now. Here's what you'll read in the next fiscal report. Debt to GDP crossed 100% due to elevated post-pandemic spending, slower than expected growth, and higher debt service costs. The Office for Budget Responsibility will note that the ratio is on a sustainable path under current fiscal rules. The Chancellor will emphasize that the UK's debt profile compares favorably to other G7 nations. And the message will be, this is a manageable transition, not a crisis. That's not what actually happened. What happened is the UK reached the point where the effective interest rate on government debt now exceeds the nominal growth rate of the economy. Let me translate that into plain English. The interest rate on government debt is what the UK pays to borrow money, currently around 4.5%. The nominal growth rate of the economy is how fast the UK's total income is growing each year, currently around 2% or less. When you're paying 4.5% interest, but your income is only growing at 2%, you're falling behind. Every year, the debt gets more expensive relative to your ability to pay it. When your borrowing costs are higher than your income growth, the only way to stop the debt from growing as a percentage of your income is to spend less than you earn before accounting for interest payments. That's called running a primary surplus. Primary means before interest. Surplus means earning more than you spend. Here's the problem. The UK is currently running a primary deficit of 2.2% of GDP. That means the government is spending 2.20 for every $2 it collects in taxes, even before paying a single penny in interest on the debt. Once you add the $126 billion in annual interest payments, the total deficit balloons to $151 billion a year. This isn't a policy choice that can be easily reversed. This is the math breaking. To stabilize the debt ratio, the UK would need to swing from a 2.2% deficit to a surplus. That's a shift of roughly $65 billion, which would require either massive spending cuts, significant tax increases, or both. And neither option is politically palatable or economically feasible without causing a recession, which would make the debt ratio worse in the short term because the economy would shrink. Here's how the system is supposed to work. The UK government issues gilts to finance its deficit. Pension funds buy those gilts as part of their liability-driven investment strategies. The funds use the gilts as collateral to lever up their hedges against interest rate risk. The gilt market stays liquid because there's a natural bid from long-duration liability matchers. The government refinances its debt at predictable intervals. The Bank of England sets monetary policy independently. And everyone assumes gilt yields stay anchored because the UK is a reserve currency sovereign with deep capital markets. That's layer one. Layer two is what pension funds actually do with those gilts. Let me break this down because it's critical to understanding why this matters. Defined benefit pension schemes are retirement plans, where employers promise to pay workers a specific amount every month after they retire. These are the traditional pensions, not the newer plans where your retirement depends on how well your investments perform. The key word is promise. The company promises to pay you, say, $2,000 a month for the rest of your life, starting when you turn 65. Now imagine you're managing one of these pension funds today, in 2026. You have workers who won't retire until 2046, 20 years from now. You need to make sure you have enough money in 20 years to pay them. Those are your long-dated liabilities, payments owed to retirees decades into the future. Here's where it gets tricky. The value of those future payments changes based on interest rates. When interest rates fall, the present value of those future payments rises. Think about it this way. If you need to have $1 million in 20 years to pay pensions and interest rates are 5%, this is a huge problem for pension funds when rates fall because suddenly they look underfunded. The value of their liabilities just jumped, and they need to find more money to cover the gap. To hedge that risk, to protect themselves against interest rates falling and their liabilities exploding, funds match the duration of their assets to their liabilities using interest rate swaps and gilt holdings. Duration is just a technical term for how sensitive something is to interest rate changes. But here's the clever part, and this is where the risk comes in. To get full coverage without tying up all their capital, they use leverage. Leverage means borrowing. They post gilts as collateral, meaning they use the government bonds they own as a guarantee. Then they borrow against those bonds in the repo market, which I'll explain in a moment. They use the borrowed money to buy more gilts or enter into more interest rate swaps. This way, a pension fund with $100 million can get the interest rate protection of $200 million or $300 million in gilts by using leverage. This strategy is called liability-driven investing, or LDI. It worked brilliantly for 15 years when interest rates were low and stable. The pension funds were protected against their liabilities growing, and they could use their remaining capital to invest in stocks and other growth assets to actually make money. But leverage is a double-edged sword. It amplifies your returns when things go your way, and it amplifies your losses and your need for cash when things go against you. Layer 3 is the repo market. This is the plumbing of the financial system, and most people have never heard of it. But it's crucial to understanding why pension funds can suddenly find themselves in crisis. Repo is short for repurchase agreement. Here's how it works in practice. Imagine a pension fund owns a government bond worth $100 million. They need cash for the day, maybe to post collateral or meet some other obligation. So they go to a bank and say, I'll sell you this bond for $100 million today, and I'll buy it back from you tomorrow for $100 at $1 million. The extra $10,000 is the interest, the cost of borrowing that money overnight. The pension fund gets the cash it needs immediately. The bank gets a secured loan, meaning a loan backed by a government bond, which is considered extremely safe. If the pension fund doesn't buy the bond back tomorrow, the bank keeps the bond and sells it. Everyone's protected. This happens thousands of times a day in the financial system. It's how banks, hedge funds, and pension funds manage their short-term cash needs. The repo market is enormous, trillions of pounds moving around daily. And it works perfectly smoothly until it doesn't. The repo agreement is renewed every day. Each day, the pension fund buys back the bond and immediately sells it again for the next night. But here's the key. The bank checks the value of that bond every single day. And this is where the danger comes in. Layer 4 is the margin call. This is where the system can spiral out of control very quickly. Remember, the pension fund borrowed $100 million from the bank using a bond as collateral. But what happens if that bond's value drops? Let's say interest rates rise, which means bond prices fall. This is an iron rule of bonds. When interest rates go up, bond prices go down. If the bond that was worth $100 million yesterday is only worth $95 million today, the bank has a problem. They lent $100 million, but they're only holding $95 million in collateral. They're exposed to a $5 million loss if the pension fund can't pay them back. So the bank calls the pension fund and says, Your collateral isn't worth enough anymore. You need to top up. Either give us another $5 million cash, or give us more bonds to make up the difference, or we're unwinding this trade right now. This is called a margin call. Now, if you're a pension fund, you have a few options. Best case scenario, you have cash sitting around. You send the bank $5 million and the problem goes away. But most pension funds run lean. They invest almost everything to maximize returns. They don't keep huge cash reserves because cash earns nothing and they need to grow their assets to pay future pensions. So if you don't have cash, option 2 is to sell some of your bonds to raise cash. You sell $5 million worth of gilts, take the cash, and send it to the bank. Problem solved, right? Wrong. Because when you sell bonds, you're pushing the price down further, which pushes interest rates up further. And when interest rates rise, all the other pension funds who also use leverage are now getting margin calls too. So they start selling bonds, which pushes rates higher, which triggers more margin calls. This is a negative feedback loop, and it's exactly what accelerated in September 2022 when 30-year yields spiked 100 basis points, meaning 1 full percentage point in just 4 days. That's an absolutely massive move in the bond market. Normally, bond markets move in tiny increments over weeks and months. When they gap by a full percent in 4 days, it means something broke. Layer 5 is the liquidation cascade. This is what happens when the feedback loop I just described doesn't stop. It's what almost destroyed the UK pension system in 2022. In September and October 2022, LDI funds sold approximately $25 billion in gilts over 5 weeks. To put that in perspective, that's roughly the size of a small country's entire annual economic output being dumped into the bond market in just over a month. 74% of the repo debt they needed to pay back came from those forced sales. The rest, the other 26%, came from cash reserves that pension funds desperately scraped together or emergency capital injections from the pension schemes themselves, where companies had to suddenly wire hundreds of millions of pounds to their pension funds to keep them from collapsing. Here's the terrifying part. The Bank of England stepped in with a temporary purchase program to stabilize the market. They essentially said, "We will buy gilts to put a floor under the price and stop the panic." Without that intervention, analysis showed that 90% of UK pension funds would have run out of collateral within days. Not months, not weeks, days. Think about what that means. 90% of British workers with traditional pensions were days away from their pension funds becoming insolvent. Not because the pensions made bad investments, not because of fraud or mismanagement, but because they used a leverage strategy that everyone thought was safe, and the market moved faster than the operational machinery could handle. The Bank of England's intervention worked. They bought $19 billion in gilts over 13 days. The market stabilized. Pension funds had time to inject capital, reduce their hedges, and rebuild their collateral buffers. Crisis averted. But here's what most people missed. The crisis was averted by an emergency intervention from the central bank. It wasn't solved. It was paused. The assumption that broke in 2022 was this: gilt yields seeing it rise faster than pension funds can post collateral. That assumption relied on 2 things that seemed completely reasonable at the time. First, that interest rates would stay low and stable as they had for 15 years. From 2009 to 2021, interest rates barely moved. Central banks kept them near zero to support economic growth after the financial crisis. Bond markets were calm. Pension funds built their entire risk models around this stability. Second, that if rates did rise, they'd rise gradually, giving funds time to adjust their hedges and recapitalize their positions. Imagine you're told that someone is going to throw a ball at you, but they'll throw it gently and give you plenty of warning. You can prepare. You can position yourself. You can catch it. That's a gradual rate rise. What happened in September 2022 was someone threw a bowling ball at your head with no warning. Both assumptions failed catastrophically. Rates didn't rise gradually over months. They gapped violently over days. In technical terms, a gap means the price jumps from one level to another without trading at the levels in between. It's like stepping on a staircase and suddenly finding yourself 3 flights up without climbing the stairs. And the gap was large enough that the operational infrastructure, meaning the legal agreements, the governance processes, the trustee approvals, the capital transfers, all the machinery that has to happen for a pension fund to respond, couldn't keep pace with the market. Pension funds have committees. They have approval processes. They have legal requirements. Moving hundreds of millions of pounds requires multiple sign-offs. That all takes time. The market doesn't wait for your committee meeting. Here's the critical point. After 2022, LDI managers increased their interest rate buffers to around 300 basis points. Let me explain what that actually means, because this number is crucial. A buffer is basically a safety margin. It is how much interest rates can move against you before you run out of collateral and get a margin call. Think of it like the space between your car and the guardrail on a mountain road. A 300 basis point buffer, which is 3 percentage points, means interest rates can rise by 3% before the pension fund is in trouble. That sounds like a lot. It's not. Here's why. The buffer is calculated against the last reset point. The last reset point was when yields were already elevated after the 2022 crisis. 30-year gilts are currently yielding 5.25%. If they move to 8.25%, which is where they'd go in a real sovereign debt repricing, when investors demand higher returns to lend to a government they think is risky, every buffer gets exhausted. Every single pension fund hits zero margin at the same moment. And we're back in September 2022, except this time there's no policy surprise to blame. In 2022, the government announced a controversial mini-budget with unfunded tax cuts, and the market freaked out. It was an unforced error, a shock that came from a policy decision. But this time, if yields spike to 8%, it won't be because of a single announcement. It'll be because the math caught up, because the market looked at $2.9 trillion in debt, $151 billion in annual borrowing, persistent deficits, and said, this doesn't work at 5% yields. We need 8% to compensate for the risk. When that happens, there's no policy to reverse, there's no mini-budget to U-turn on. It's just structural reality repricing, and that's much harder to fix. Walk through the stress scenario. Start with the baseline. UK debt to GDP is 100%. Annual borrowing requirement is $151 billion. Debt service costs are $126 billion, which is 3.5% of GDP. 10-year gilt yields are 4.5%. 30-year yields are 5.25%. The Bank of England is selling gilts as part of quantitative tightening. That's $80 billion in additional supply hitting the market this year. Pension funds hold over $600 billion in index-linked gilts and $1.2 trillion in nominal gilts. They're the marginal buyer. They're also the marginal seller when they need liquidity. Now introduce the new condition. Gilt yields rise 150 basis points over 3 months. Not because of a policy shock, just because the market reprices UK sovereign risk as debt approaches 105% of GDP and primary deficits persist. 30-year yields touch 6.75%. Pension funds with 300 basis point buffers are now at 150 basis points of remaining capacity. Repo counterparties start asking for additional collateral. Funds that allocated their liquidity buffers to meet earlier margin calls now have to sell. The Debt Management Office is trying to place $230 billion in gross issuance into a market where the natural buyers are selling. Yields gap wider. 7%, then 7.5%. This is where the math breaks. At 7.5% 30-year yields, the average LDI fund is out of collateral. They're not out because they made a bad bet. They're out because the system was designed for a 4% yield environment with gradual moves. It wasn't designed for a 7.5% yield environment with gaps. The funds have 3 options. Inject new capital, which requires trustee approval and takes weeks, or reduce the hedge, which means accepting liability mismatch and potentially violating funding rules, or liquidate the position entirely, which means selling gilts into a falling market and crystallizing losses. Most funds can't inject capital fast enough. Remember, these are pension schemes with trustees, legal requirements, and governance processes. Wiring $500 million to meet a margin call requires board approval, legal sign-off, and coordination across multiple entities. That takes days, sometimes weeks. The market doesn't wait days. Most funds can't reduce the hedge without regulatory consequences. UK pension regulators require funds to maintain certain funding levels. If you reduce your hedge, you're accepting liability mismatch, which means you're no longer protected if interest rates move. That can violate your regulatory requirements and put the fund in technical breach of its legal obligations. So most funds sell. They're forced to sell. And when most funds sell at the same time, there's no bid. Let me explain what that means. In a normal market, there are always buyers and sellers. You want to sell a bond, someone else wants to buy it. The price is somewhere in the middle. But in a stressed market, when everyone needs to sell and almost no one wants to buy, there's no bid. A bid is an offer to buy. When there's no bid, it means you can't find anyone willing to take the other side of your trade at any reasonable price. Market makers, the big banks and trading firms whose job is to buy and sell to keep markets functioning, they step back. They're not charities. They're not going to buy bonds that are falling in price just to help pension funds. They step back and wait for the market to stabilize. So the spread widens. The spread is the difference between where you can buy a bond and where you can sell it. In a normal, healthy market, that spread is tiny, maybe 2 basis points, which is 0.02%. You can buy a gilt at one price and sell it at almost the same price. But in a crisis, that spread blows out. It goes from 2 basis points to 20, then 50, then the market stops trading in size. You have a price on the screen. Your computer shows that 30-year gilts are trading at 8% yield, but you can't execute at that price. When you try to sell $100 million, you find there are no buyers. Or the only buyers want to pay you a price that reflects a 9% yield, a full percentage point worse than the screen price. This is what's called a liquidity event. It's not a solvency event. This is crucial to understand. The pension funds aren't bankrupt. They have assets. They own valuable bonds and other investments. They're not insolvent, but they can't access cash fast enough to meet their immediate obligations. It's the difference between being broke and having all your money tied up in a house you can't sell. You're wealthy on paper, but you can't pay your bills today. Here's the analogy. Imagine a dam. Not a small dam, but a massive concrete structure holding back a reservoir. The dam holds back water. The water is the cumulative deficit, all the years of government spending more than it takes in. Every year, the government adds more water to the reservoir. It has to, because it's running a deficit. And every year, the dam gets a little weaker, not because it's poorly built, but because the ratio of water to dam capacity increases. More pressure, same structure. The dam is the gilt market's ability to absorb supply. It's the collective willingness of investors, pension funds, insurance companies, foreign governments, to keep buying UK government debt at reasonable interest rates. That capacity isn't infinite. It depends on confidence in the UK economy, the attractiveness of the yield, and the availability of alternative investments. Now imagine a crack appears in the dam, a small one at first. The crack doesn't appear because someone broke the dam or sabotaged it. It appears because the pressure finally exceeded the design threshold. The dam was built to handle a certain amount of water at a certain pressure level, but the water kept rising, the pressure kept building, and eventually physics wins. Water starts flowing through the crack. Just a trickle at first, but water flowing through a crack erodes the material around it. The crack gets bigger. More water flows through. The pressure on the rest of the dam increases because now the total force is concentrated on a smaller area. More cracks appear. The flow accelerates. At some point, the question isn't whether the dam will hold. The question is whether you can reduce the inflow fast enough to prevent a cascade. Can you stop adding water to the reservoir faster than it's leaking out? Can you reinforce the structure before the whole thing fails? That's where we are. The crack is the persistent primary deficit, the fact that the government is spending more than it earns even before paying interest. The flow is the borrowing requirement, the $151 billion a year the government needs to borrow just to keep operating. The cascade is the reflexive selling from pension funds when yields gap beyond their buffer capacity, when interest rates move so fast that funds are forced to sell bonds, which pushes rates higher, which forces more selling. And the inflow is the structural gap between government spending and revenue that can't be closed without either deep cuts to public services, which are already stretched thin, or significant tax increases, which would slow economic growth. Both options reduce growth in the short term and make the debt ratio worse because the denominator, the size of the economy, shrinks or grows slower. Stay with me, because this is where it changes. We're now in a split reality. There are two versions of the UK gilt market existing at the same time, and most people only see one of them. There's the price reality and the structural reality. In the price reality, the one you see if you check financial news or look at a bond trading screen, gilts are yielding 4.5% on the 10-year. The market looks liquid, meaning you can buy and sell without major price impact. Auctions are clearing, meaning when the government sells new bonds, people are buying them. The Debt Management Office, the government agency responsible for issuing gilts, is placing its supply without major disruption. Pension funds have rebuilt their buffers after 2022. Everything looks stable, the headlines are calm, the system appears to be functioning normally. But there's another reality underneath, the structural reality. The one you only see if you are tracking flows and understanding who's buying and who's selling and why. In the structural reality, the UK government needs to issue $230 billion in gross gilts this year. That's new issuance to finance the deficit and refinance maturing bonds. On top of that, the Bank of England is selling $80 billion of gilts as part of quantitative tightening, unwinding the emergency bond purchases they made during the pandemic and the financial crisis. That's $310 billion in total supply hitting the market in 1 year. To put that in perspective, that's more than 10% of the entire UK economy flooding into the bond market. Now, who's buying all those bonds? This is where it gets concerning. The natural buyers, the pension funds that used to be the backbone of gilt demand, they're reducing their gilt allocations. They're delevering their LDI books, meaning they're using less borrowed money, because they learned the hard way in 2022 that leverage is a liability when volatility spikes. They're still buying, but not at the same scale as before. Foreign buyers, particularly central banks and sovereign wealth funds, are underweight UK duration. That means they own fewer long-term UK bonds than they historically did. Why? Because real yields, meaning returns after inflation, are better in the United States. And the political risk premium is higher in the UK after multiple fiscal crises in just 3 years. If you're managing a $1 trillion portfolio, would you rather lend money to the US government or the UK government? The answer is obvious. Domestic insurance companies, which used to be big gilt buyers, are rotating into corporate credit. They're buying corporate bonds instead because the spread, the extra yield they earn for taking on corporate risk instead of government risk, compensates them for the difference. Why buy a government bond yielding 4.5% when you can buy a solid corporate bond yielding 6%? So who's buying? The answer is price. The market clears, meaning buyers and sellers find each other, but only at a yield high enough to attract buyers. And that clearing yield is now structurally higher than it was 3 years ago, not because UK fundamentals improved, they got worse, but because the buyer base shrunk and the supply increased. This is the divergence. The narrative, the story you read in the news, says the system is stable. The mechanics, the actual plumbing of who's buying and selling and why, say the system is repricing. And repricing isn't smooth. It doesn't happen in small, gradual increments. It's step functions. It's sudden jumps. It's days where 30-year yields move 40 basis points, nearly 0.5%, because someone big needed to sell and there was no natural buyer to offset that sale. There are 3 possible outcomes here. Let me walk you through each one and what it would actually require. The first is the impossible one, the fantasy scenario. The UK runs sustained primary surpluses, grows its way out of the debt ratio, and stabilizes the fiscal trajectory without a crisis. What would this actually require? Running a primary surplus of 4.7% of GDP for 10 consecutive years. In today's terms, that's $137 billion a year in surpluses. Let me put that in context. The entire UK defense budget is about $50 billion. The entire education budget is about $100 billion. Finding $137 billion to cut every single year for a decade, while the population is aging and healthcare costs are rising and infrastructure is crumbling, is not politically feasible. Or you could raise taxes by $137 billion a year. That would require increasing income tax rates by roughly 40% across the board, or doubling VAT from 20% to 40%. Neither of these would ever pass Parliament. And even if they did, raising taxes that aggressively would crash the economy, trigger a recession, and make the debt ratio worse in the short term because tax revenues would collapse when businesses close and people lose jobs. It's not happening. The politics don't support it. The growth isn't there to grow your way out of it. The UK economy is growing at maybe 1 to 1.5% a year, well below what's needed, and the demographics are moving the wrong way. An aging population means more retirees collecting pensions and using healthcare, and fewer workers paying taxes. The math doesn't work. The second outcome is the default scenario. Not a literal default where the UK says, we're not paying our debts. That won't happen. The UK can always print pounds to pay pound-denominated debt. But this is a policy default, a subtle form of not honoring the spirit of the obligation even while technically paying. Here's how it works. The government changes the rules in ways that force people to absorb losses without calling it a default. They extend maturities, meaning when a bond comes due, instead of paying you back, they say, we're going to pay you back later, and here's a new bond with a longer maturity. They force pension funds to hold gilts as part of their capital requirements, essentially mandating that pensions buy government bonds, whether they want to or not. They introduce financial repression through regulatory mandates. Financial repression is when the government uses regulations to force savers and investors to accept below-market returns on government debt. For example, they might say banks have to hold a certain percentage of their assets in government bonds, or pension funds must allocate a minimum amount to gilts. This creates artificial demand and keeps yields lower than they would be in a free market. Most insidiously, they let inflation run higher to erode the real value of the debt. This is the stealth default. Imagine the government owes you $100,000, and inflation runs at 6% a year instead of the 2% target. After 10 years, that $100,000 they pay back to you has the purchasing power of only $55,000 in today's money. They paid you back in full, nominally, but they paid you back in money that's worth half as much. You lose. The government wins. This is the path most overleveraged sovereigns take when they can't grow and won't cut spending. It's managed decline. It's death by 1,000 cuts. And the cost is borne by savers, pensioners, and anyone holding long-duration fixed income. If you're a retiree living on a fixed pension and inflation runs hot for a decade, your standard of living gets quietly cut in half. If you own government bonds, your real returns are negative. You're losing money every year after accounting for inflation, but it happens slowly enough that there's no crisis moment, no headline, no panic. The third outcome is the managed crisis. This is essentially a repeat of 2022, but potentially worse. Here's how it plays out. Yields spike. Maybe not gradually over months, but violently over days or weeks. 30-year gilt yields jump from 5.25% to 7%, then 8%. Pension funds hit their buffers. The 300 basis points of safety margin they built up after 2022 gets exhausted. Margin calls start flooding in. Funds need to post collateral they don't have. They start selling bonds to raise cash. That selling pushes yields even higher, triggering more margin calls in a vicious cycle. The Bank of England has to intervene again, but this time they can't just do it quietly. They need explicit fiscal coordination, meaning the bank and the Treasury, the government's finance ministry, have to work together publicly. The bank steps in to buy gilts and stabilize the market, just like in 2022. But simultaneously, the government has to announce an emergency budget to restore credibility. What does that emergency budget look like? Spending is cut. Maybe they freeze public sector wages, meaning government workers get no raises even as inflation eats away at their purchasing power. Maybe they delay infrastructure projects. Maybe they cut benefits or reduce public services. Taxes are raised. Perhaps income tax goes up a percentage point or two. Perhaps capital gains tax increases. Perhaps they introduce new taxes on wealth or property. The fiscal rules get rewritten. The government changes the definition of what counts as sustainable debt, or they change the time frame for achieving fiscal targets, essentially moving the goalposts to make the current trajectory look acceptable. The market stabilizes after this emergency package is announced. Yields come back down from 8% to maybe 6%. The panic subsides. But we're left with a higher equilibrium yield, meaning the new normal for UK borrowing costs is structurally higher than before, and a lower growth trajectory because all those spending cuts and tax increases slow the economy. This is the 2022 playbook. It worked once, the bank stepped in, the government changed course, the market calmed down. But the probability it works again is lower for two reasons. First, the credibility cost of the first intervention was high. The market learned that the UK government will blink before the pension system fails. That's valuable information for bond investors. They now know there's a floor under the market, a point at which the authorities will intervene. That creates moral hazard, meaning investors might take on more risk knowing they'll be bailed out, which makes the next crisis bigger. Second, the buffers are thinner this time. Pension funds have less room to maneuver. Government finances are worse. The deficit is larger. The debt is higher. The margin for error has shrunk. If yields spike again, the intervention needs to be bigger, faster, and more credible than last time. And there's no guarantee the market believes it. Assign rough probabilities. Outcome 1, the clean exit is maybe 5%. Outcome 2, the policy default through inflation and repression is 60%. Outcome 3, another managed crisis with intervention, is 35%. Those probabilities shift based on external shocks. If the US enters a recession and global risk-off drives flows into developed market bonds, the UK gets a reprieve. If inflation resurges and central banks have to hike again, the probability of outcome 3 rises sharply. What this means for you is not to panic. Do not panic. Panicking doesn't help. What helps is positioning, understanding the risks, and making informed decisions about your money and your future. If you're holding long-dated UK gilts, meaning bonds that mature in 20 or 30 years, you need to understand what you're holding. So you're holding duration risk in a market that's structurally short liquidity. Duration risk means your bond's value is very sensitive to interest rate changes. If rates rise, the value of your bond falls significantly. And in a market that's short liquidity, when you need to sell, you might not find a buyer at a reasonable price. That's a trade, not an investment. A trade is something you hold for specific reasons and watch carefully, ready to exit when conditions change. An investment is something you buy and hold for the long term. Long-dated gilts right now are a trade. If you own them, understand why you own them and what your exit plan is if yields spike. If you're in a defined benefit pension scheme, meaning a traditional pension where your employer promises you a specific payment in retirement, your fund is likely managing this LDI risk. The trustees and fund managers are paying attention to this, but you should understand that the security of your future benefit depends on the scheme's ability to navigate yield volatility without being forced into selling assets at a loss. You can ask your pension fund questions. How much leverage are they using? What are their interest rate buffers? What's their collateral management process? Most people never ask these questions, but you have a right to know. Your retirement depends on it. If you own UK equities, stocks in British companies, you're exposed to the growth impact of fiscal tightening. Fiscal tightening means the government cuts spending or raises taxes to reduce the deficit. When that happens, it slows the economy. Companies make less profit. Stock prices can fall, at least in the short term. That doesn't mean you should sell all your stocks, but it means you should understand the risk. If outcome 3 happens, if we get another managed crisis with emergency budget cuts and tax increases, expect UK stocks to take a hit. The strategic mindset here is simple. Don't fight the math. The UK has a debt problem that becomes a funding problem when yields reprice. Yields repricing means investors demand higher interest rates to lend to the UK government because they perceive higher risk. That repricing might happen gradually, over years, as the market slowly digests the reality of higher supply and a shrinking buyer base. In that case, you have time to adjust your positions, rebalance your portfolio, and make changes gradually. Or it might happen suddenly, in a week or even days, when an external shock or a domestic policy error triggers a gap move in yields. You can't predict the timing. Nobody can. Not the Bank of England, not the Treasury, not the smartest bond traders in London. But you can position for the mechanics. You can understand what's likely to happen and make sure your financial situation can withstand it. Here are the indicators to watch. These are the specific metrics that will tell you when stress is building in the system. You don't need to check these every day or become obsessed with them. But checking once a week will keep you informed. First indicator, the 30-year gilt yield. Not the 10-year that gets quoted in most news articles. The 30-year is where pension fund duration risk lives. This is the yield that matters most for the LDI strategies we've been discussing. If 30-year yields move above 6% and stay there for more than a few days, that's a signal that the market is pricing in either much higher inflation expectations or much higher sovereign risk, meaning investors are more worried about lending to the UK government. You can check this on any financial news website. Just search for UK 30-year gilt yield. If you see it above 6%, pay attention. If it stays above 6% for a week or more, that's concerning. Second indicator, the spread between UK and US 30-year yields. This tells you how much extra return investors demand to lend to the UK versus the US. Right now, that spread is somewhere around 50 to 100 basis points, meaning UK 30-year bonds yield 0.5 to 1% more than US 30-year bonds. If that spread widens beyond 200 basis points, meaning the UK is paying 2% more than the US, it means global investors are demanding a significant premium to hold UK duration. They're seeing the UK as meaningfully riskier than the US. That's a warning sign. It means the international investor base is pulling back from UK debt. Third indicator, the Debt Management Office's auction results. The DMO holds regular auctions where they sell new government bonds. You want to watch two numbers from these auctions. The bid-to-cover ratio is how many bids they received divided by how much they were selling. If they're selling $5 billion in bonds and they receive $15 billion in bids, the bid-to-cover ratio is 3.0. That's healthy. It means there's strong demand. If that ratio falls below 2.0, it means demand is weakening. Below 1.5, and you're in concerning territory. The tail is the difference between the average yield across all successful bids and the highest yield that was accepted. In a smooth auction, everyone bids at similar yields, and the tail is maybe 1 or 2 basis points. If the tail widens to 10 or 15 basis points, it means the DMO had to accept much higher yields at the margin to place all the bonds. That indicates the auction was hard to clear, meaning they struggled to find enough buyers. You can find auction results on the DMO's website or in financial news coverage. They're published within hours of each auction. Fourth indicator, the Bank of England's Financial Stability Report. The bank publishes this twice a year, and it includes stress test results for the LDI sector. They model what would happen to pension funds if yields spiked by various amounts. You're looking for the buffer numbers. If pension fund buffers start compressing below 250 basis points on average, you're back in the danger zone. That means the average fund can only withstand a 2.5% move in yields before hitting margin calls. Given that we saw a 1% move in 4 days in 2022, a 2.5% buffer isn't much. Fifth indicator, fiscal data, specifically the primary deficit. This is reported monthly by the Office for National Statistics. The primary deficit is government spending minus tax revenue before accounting for interest payments. If the primary deficit is not moving toward surplus, or at least moving toward balance, the trajectory doesn't change. All the debt dynamics we've discussed stay in place. The market will eventually reprice that reality. You want to see that monthly deficit number trending down over time. If it's staying flat or getting worse, that's a sign the government isn't making progress on fixing the structural problem. Check these 5 indicators once a week, maybe Sunday evening. Spend 15 minutes reviewing them. Not obsessively, not anxiously, just staying aware. Because the nature of these events is that they escalate faster than institutions can respond. By the time it's a headline, by the time it's on the front page of the Financial Times or the BBC, it's already a crisis. The edge, the advantage, is in seeing the setup before the move happens. Zoom out for a moment. This isn't just about the UK. This is about something much bigger. This is about the end of the zero-rate regime and what that means for over-leveraged fiscal systems across the developed world. For 15 years, from roughly 2009 to 2022, governments in developed countries borrowed at interest rates below their economic growth rates. Think about what that meant. If you're the UK government growing at 2% a year and borrowing at 1% interest, the debt is essentially free. Better than free, actually. It's profitable. Because inflation, even at just 2%, erodes the real value of that debt faster than interest accrues. Every year, what you owe is worth less in real purchasing power terms. You're getting paid to borrow. That regime ended in 2022. Central banks started raising interest rates aggressively to fight inflation. The era of free money ended abruptly. Now governments are paying real rates, meaning interest rates adjusted for inflation above 2%. Meanwhile, growth is stuck below 2% across most of the developed world. The math flipped. It went from profitable to borrow to expensive to borrow almost overnight. And here's the problem. The math only works now if you run surpluses or accept higher inflation. If you're paying 4.5% on your debt and growing at 1.5%, you're falling behind unless you spend less than you earn. But most developed economies aren't running surpluses. Most developed economies are running deficits, often large deficits. That means the pressure is building across the entire system. It's not just the UK. The UK is just further along the curve ahead of the others because of specific factors. Brexit reduced growth and trade. Demographics are particularly challenging with an aging population. Productivity growth has been weak for over a decade. But the same fundamental dynamics are in play in France, where debt to GDP is over 110% and the government is running a 5% deficit. In Italy, where debt is 140% of GDP and political instability is chronic. In Japan, where debt is over 250% of GDP, though they have unique factors like most of that debt being owned domestically. Even in the United States, where debt is approaching 130% of GDP and the deficit is running over $1.5 trillion a year. Everywhere you look in the developed world, debt to GDP ratios are rising. Interest burdens are rising as old low-rate debt matures and gets refinanced at higher rates. Primary deficits are persistent because governments politically cannot cut spending or raise taxes enough to balance their budgets. And the buyer base for government bonds is shrinking as central banks reverse quantitative easing, selling bonds instead of buying them, and as foreign reserve managers diversify away from low-yielding developed market sovereigns toward higher-yielding emerging markets or alternative assets. The UK crossing 100% debt to GDP isn't a local British problem. It's a leading indicator, a warning sign of what's coming in other markets. It's what happens when a developed market with deep capital markets, a long history of financial stability, and an independent central bank runs out of fiscal space during a monetary tightening cycle. The UK is the canary in the coal mine. And what happens next in the UK, whether it's managed decline through inflation and financial repression, another emergency intervention and crisis management, or an actual bond market repricing event that forces brutal fiscal adjustment, that's the template. That's the playbook for what's likely to unfold in France, Italy, Japan, and eventually even the United States over the coming years. The timescales will differ. The specific triggers will vary. But the underlying dynamics are the same. The question is not if the gilt curve reprices to reflect the structural deficit. The question is how long the pension system can withstand the volatility of that repricing without triggering another liquidation event, and whether the political system can deliver the fiscal adjustment necessary to stabilize the trajectory before the market forces it. The crossing already happened. The headline came and went. What matters now is what's accumulating beneath the curve: the supply, the leverage, the shrinking liquidity, the reflexive selling, the assumption that it can be managed because it was managed before. That assumption held once. It might hold again. But the distance between stable and unstable is measured in basis points and collateral calls, and that distance is narrowing.